Hello everyone, and thank you for joining us today for the webinar on an overview of FTA audit, penalties and recent clarifications. Before we begin, please note that you are in listen-only mode. If you have any questions, please share them with us through the question box. We will address your queries towards the end of the webinar or in writing if time does not permit us to cover them during our webcast today. We will also be sharing this copy of the presentation post this webinar. The Federal Tax Authority has revised penalties by issuing decision number 49 of 2021, amending provisions of Cabinet Decision 40 of 2017, regulating tax penalties imposed for violation of tax laws in the UAE. Prior to the issuance of executive regulation for tax procedures, there were certain areas where clarity was required. On account of the said ER, the same would be clear and serve as a checklist that can be followed easily while avoiding the penalties. In today's webinar, we will discuss different aspects of the FTA audit and recent clarifications issued so that the taxpayers are better equipped and in compliance with the laws. Joining the discussion today, we have Saket Patwari, Executive Director, and Ankit Nagda, Manager, Indirect Tax at Nexdigm. Saket leads the indirect tax practice at Nexdigm. He has over 16 years of experience in indirect tax advisory, policy advocacy, and dispute resolution. He has headed indirect tax function for one of the largest telecom company in his previous role. Saket regularly addresses sessions and seminars organized by prominent institutes, industry bodies, and bilateral chambers. Ankit is a manager at Nexdigm. He has over 7 years of experience in indirect tax advisory and compliance. Ankit has been supporting GCC-based clients for entire bouquet of VAT-related services and also working with many Indian companies on GST-related offerings. Thank you, Saket and Ankit, for joining us. Over to you, Saket.
Good morning, everyone. Today the topic is FTA audit and the penalties which have been revised in the recent amendments in the executive regulations. So what we'll be covering today is, next slide please, Ankit. Brief understanding of an FTA audit. What does it entail? What is it exactly all about? Approach for being prepared for this audit and why it's necessary to prepare for this audit. And amendments in the administrative penalties, which in that sense quite benevolent because there have been reductions in some of the penalties they're imposed by the FTA. What are the key violations, revisions in administrative penalty that I've spoken about, and an amnesty scheme. If you see across the globe, amnesty schemes generally come quite late, but here I think in about 3 to 4 years time we have got an amnesty scheme and other amendments in executive regulations. Post that we'll have a question answer session, and you all can post your question in the box so that we can answer those questions. Yeah. Now, what is an FTA audit? We all know that it's a self-assessment regime in the UAE. Self-assessment means what? You, the taxpayer, does the assessment of its tax liability, files its returns, and pays the tax. Okay. So all throughout, it's the understanding of the law, understanding of the tax liability of the taxpayer. How does the tax office know that this is correct or wrong? The mechanism comes through FTA audit, wherein under FTA audit, the tax FTAs, they verify the records, etc., which we'll discuss in the subsequent slides, what all they do. But what happens is they scrutinize all our record systems, etc., to see whether everything is proper and fine or not. FTA, so this is a legal requirement which everyone is obliged to adhere to, that whenever the FTA officer comes for the audits or whenever these audits happen, we provide all the relevant information, all the relevant supports for him to examine the records and to be satisfied whether the taxes are correctly paid or not. Okay. Typically, they will send a notice of around 5 days in advance or maybe a week in advance, which means it's a very stringent time and we need to adhere to these timelines, right? Apart from that, there are audit what VAT audit basically includes if there is an overestimated of tax credits that you have taken, or understatement of the output tax, or there is insufficient documentation. There is some procedural lapse or documentation, etc. that is there that it will entail. And what it may lead to is, and which is why it's very critical that we place utmost caution and be very, very serious about it. What it could lead to is identification of underpayment of VAT, or or penalties on non-compliances, etc., which may have to be paid. Now, these penalties for for not supporting, suppose the tax auditor, is around 20,000 dirham, and there are various penalties which Ankit will discuss in detail in the subsequent slides. Yeah, next slide, please. Now, what is the scope of audit? How does, broadly, what would happen during an audit? Typically, the officers would want to first get into understanding, typically how generally an audit happens. They want to first understand the business of the taxpayer, which industry he is in, what are the various peculiarities of industries. Different industries have different peculiarities, different nomenclature, different things, and different ways of business. So they would want to gain a bit of that understanding, so that in light of that, they can look at the nature of transactions which are there, and the nature of transaction where there can be a risk, or where there can be a possible short payment of tax or availment of credit. They also look at the accounting systems. In accounting information system, they'll check whether we have all the controls in place from an accounting point of view, so that none of the transactions go missed, or there are transactions which are not outside the system. So they do various control checks, measures through the accounting information system. They will check our master data, our basic transaction, the kind of entire database of vendor, customer, etc., and various transactions, to review if there are to gain basic understanding or framework for conducting an audit. And from that, they may select some sample which they may check, and basis, and for that they may check the sample through and through, right from the start of the transaction, what are the various documentation prepared, till the end of the transaction. So which we call it an audit trail. Suppose that once they are satisfied with the financial data, etc., they will compare it with the compliance and VAT returns vis-a-vis the law, whether it's satisfied, whether it is in sync with the financial records that they have looked at, or they will be looking at, and also the law, whether they are in compliance with the law, whether everything is appropriately recorded. It may also entail that they may do a reconciliation of income and expenses, of our revenues as well as expenses, vis-a-vis what is reported in the returns, vis-a-vis various other records, so that all across everything should tie in, so that they are satisfied in terms of whether the records are maintained properly and there is appropriate taxation, which was supposed to be paid is paid. Now, this audit may conduct an audit after 5 years from the end of the relevant tax period. So there is a 5-year window period available for this. However, if there is any evasion of tax, this may increase to 15 years. Now, I'll just give an example from an India point of view. India, typically the period is 3 years and 5 years. In case of evasion, then the period is 5 years. Here, they are very, very strict. And if there is an evasion, they want to really be very, very strict about it. Hence, if there is no evasion, 5-year period. If there is an evasion, if they foresee an evasion, then as light as 15 years, they can go back to, to do audit and to get to impose demand. So this is the scope of the audit, and I'll invite Ankit to take forward the session with various details on audits as well as the penalty provisions, etc., which we spoke. Thank you. Yes, Ankit.
Thanks, Ankit. So I think he has set the context very rightly for the audit, the revisions and penalties, and the changes in executive regulations. So before initiating the audit, the FTA authority send a FAF, which is generally known as the FTA audit file, where they usually collect the details relating to the return in a particular manner, which is described further in detail in the ensuing slides. And also they'll collect basic information like the general ledger, the master ledgers, and various information which will help them to carry out the audit at the clients, at the taxpayer's office. And they would, even after receiving the data, carry out a working at their end to identify the issues that may come up in the course of audit. So it is very important to ensure that the workings are ready prior to receiving the FAF, so that there is no time issue when the FAF is received by the taxpayer. Further, once the request is received, in the output invoices that are being raised by the taxpayers, the following criteria are being checked, which we generally as a consultant would review at the time of filing the returns, so as to ensure that if there are any shortcomings in the invoice that are raised, are corrected at that time itself, and no, we are not inviting a penalty for us at a later time. The basic descriptions or the particulars which are referred to in the checklist is that the document should be titled as tax invoice. There should be a number to it. There should be a date to it. The taxable amount, VAT amount, and the total amount should be appearing clearly. The customer's name, their TRN, and the description of supply which is being made should be clearly visible on the invoice that are being raised. So here, you will be able to see there are ticks, there are green ticks in certain sections, there are red ticks in certain sections, which means the green ticks are required in those particular sections always. There is no exception to those green ticks at any given point of time. But in case of, I'll just take a sample of zero rated output where the VAT amount in AED is appearing as cross, which means that because it's a zero rated supply, VAT amount need not be mentioned. But as a matter of good practice and to be, sure about the taxability, it would be recommended to write that it is a zero rated supply, or it is taxable at 0%, so that there is no discrepancy or no question from the FTA at the time of audit. And there are similar columns or the requirements for the supplies which are exempt from VAT and the supplies which are outside the scope of VAT. Going ahead, such similar requirements are even required at the time for the purchases which are made by the taxpayers, and the details are similar to those of the output supply. The only specific or additions which come in here are that the tax invoice should be paid, or the intended date to pay the invoice should be appearing in the working file which is going to be prepared before the audit. And the other details specifically relating to the supplier, that is supplier's name, supplier's address, and the TRN should be appearing in the working file. Apart from this, in case of import of goods, the items appearing here, which are also available from the FTA portal before the filing of return. Kindly be mindful that if there are any import of goods which are happening in the particular company, the information is downloaded at the time of filing the return or prior to that, because once the return is getting filed, the details relating to the particular periods, the details of import of goods relating to the particular period are not available once the returns are filed. And that could be a concern once we are in the course of filing a refund application or preparing the FAF, because these details are very specific, which would not be available, which may not be available in the documents that the taxpayer may have. Moving ahead, the reconciliation format is also designed by the FTA authorities, which is appearing over here, and which is as per the VAT return. That is the supplies made within the 7 emirates of UAE, and the other supplies which are appearing in the return, that is zero rate supplies and the exempt supplies. So you are comparing your output as per the returns, and then your income as per the trial balance, which is, operational income would be majorly covered over here. Apart from that, there could be some other incomes which, in the nature of interest or dividend or sale of scrap, which may appear in other sections in the trial balance. Not necessarily that, the sales of scrap would come in operational income. It may come in other income also. And thereafter, we need to carry out or, provide detailed reasons for the differences which are appearing in this reconciliation. So the sample reasons could be that, the sale of goods from outside UAE to UAE to outside UAE will not appear in the return, but they will appear in the trial balance because it's an income at the end of the day for the business. Apart from this, we should, have a system wherein this information is available within the the accounting system itself, so that there is no extra effort required at the time of preparing this file. Or if the systems cannot be changed, it is advisable to prepare it well in advance, considering the fact that the information which is required by the authorities for the audit is very comprehensive and very detailed. Further, if you are claiming any export related benefits for services or goods, the relevant document to support it, for example, the agreement which would have been entered by the client with the third party for any supplies, that should be available, which should clearly state that it's a zero rate supply or the place of supply is outside the UAE region. Further, in case of export of goods, the customs document and the bill of lading and the supporting document should be available. Without which it cannot be, they may question the benefit which has been taken by the taxpayer. And regarding import of goods, which we have discussed in detail in the earlier slide, that the relevant details available on the FTA portal should be available with us, and the appropriate reconciliation should be carried out prior to or at the time of filing the return, so as to ensure that the details appearing on the FTA portal and in our books is matching. And the authorities also have a right to review the company's accounting software, that is to ensure that all the information which is provided to the tax authorities is also appearing in the accounting system, and there are no mismatches in the details which have been shared. Moving ahead, the common issues that may come up during the audit, which is common across the entire globe, is in case of, I'm just taking a few samples of it. That is a transitional credit which may be there in case, if there is any tax law which is there and there is some change in the law in the entire country. So in that cases, there could be a transitional credit which would be carried forward, and for which appropriate calculation should be maintained and the relevant documents. Further, there could be expenses which are incurred for the businesses, but they are for the employees, and which may be considered as a expense incurred for the personal benefit of employees and not for the business. In which case, it is advisable to have a company policy in place to justify the claim that it is specifically for the business and not for the employees' individual's benefit. And there have been also scenarios during the refund review that they usually disallow the mobile charges or specifically the accommodation provided to the employees for the initial period when they are migrating to UAE from another country. So it's better to have a policy in place so as to justify the claim which is being made by the taxpayer. Else, there could be a reversal of those credits and a penalty stating that it is wrongly claimed by the taxpayer. Further, so given the entire background or the requirements which are to be prepared for a FTA audit, the action points which are to be taken by a taxpayer along with the support of the consultant or the other team members is to ensure that the documents which are required by the FTA format are available. Any supporting documents in case of zero rate supplies or import of goods are available with us prior hand, and it is organized in a proper manner. Further, that the revenue and expense are reconciled prior hand. This should be ideally be carried out at the time of filing the return itself, so that there is no extra effort which is required at the later point in time. And also, if any tax position have been taken at the time of implementation of VAT, whether any revisions are required to be done to those at present, because there are usually some of the other changes which are coming out in the subsequent years in the UAE region also. But however, in the UAE region, there are not many changes which have been done till date. There are a couple of clarifications which have been provided by the FTA authorities on some particular aspects of the UAE VAT law. And further, it is important to prepare everything in advance and not buy time at the time of receipt of notice, which may be construed by the FTA authorities that we are trying to make some planning at that time to avoid any tax liability or tax penalties. Going ahead, now we'll discuss the penalties which have undergone a change. So there are a lot many penalties which have been, reduced or amendment, or the criteria have been changed for levying penalties. We will be discussing in detail the 4 penalties which are, which comes up during the normal course of businesses for the taxpayer. One is penalty for late payment of tax on filing the tax return. Second is the penalty for filing incorrect return. Third is penalty on submission of VD, that is a voluntary disclosure, before a FTA audit notification is being given by them. And thereafter, the last one is penalty on submission of VD after receiving the audit notice from the authorities. So now the first one, that is penalty for late payment of tax, which is due on filing of tax return. The existing penalty was, if the tax is not paid on the due date, then the immediate next day, the 2% penalty starts on a daily basis. Thereafter, if the tax is unpaid for 7 days, from the 8th day, 4% penalty gets started hitting to your account. And if that is unpaid for a month, then 1% daily penalty is levied, wherein a maximum cap of 300 is kept. So there is no option available to the taxpayer to immediately pay the to avoid the payment of tax, because penalty is getting added every day on the portal, and it is not the case that where we are getting an option to defend our case or to give some reasons to the FTA. If this is not paid, it will get added, or it would appear in the unpaid tax on the FTA portal. Now the main revision which has come in this penalty is that the first 2% is the same. However, the 4% on a daily basis is changed to 4% on a monthly basis, which means that there is quite a decent amount of time available to the taxpayers to discharge their penalty for late payment of tax. But it is better to avoid any penalties for such small petty things. Obviously, if there are issues due to cash flows, that can be then taken care. Otherwise, it should be paid at the same time of filing the return or prior to filing the return. Moving ahead, there are penalties for incorrect filing of return. In the existing regime, there's a penalty of 3,000 for the first time and 5,000 in case of repetition. This would usually happen at the time of a refund review or at the time of FTA audit. It would not happen prior to those events. But in case of late payment of tax, it happens even immediately at the time of filing the return. In the revised cabinet decision, the penalties is 1,000 for the first time, 2,000 in case of repetition. They have introduced a very nice clause, which is user friendly or the taxpayer friendly, that if the change or difference in the penalty, if the tax difference is less than the fixed penalty, then they shall levy a penalty for the difference, but which should not be less than 500. And they have also made a new clause or new provision in the law stating that if a return for a particular period is filed earlier than the due date and the return is getting revised by the due date, there would be no penalties, which is a very welcoming clause for the taxpayers, so that if there are any errors which are identified post filing the returns, they could be corrected. Moving ahead on the next penalty, which is quite important to understand so as to ensure that we are compliant with the tax penalties that are getting imposed. So in case a voluntary disclosure is submitted before the FTA audit notification, voluntary disclosure is basically to rectify any errors which have been identified in the entire return for a particular period. So the penalty is in 3 parts. One, there is a fixed VD penalty. That is, in the old regime, it was a 3,000 for the first time, 5,000 in case of repetition, and a variable 5% penalty. And there is also a late payment penalty of the tax, which is similar to the tax penalties, which are levied at the time of late filing of tax in case of return filing. So there is a benefit which is given by the authorities even in case of late payment of tax when a VD is submitted. And the revisions in the penalties for submission of VD are that the fixed penalty has been reduced to 1,000 and 2,000 for this first time in the case of repetition, and the variable penalty is depending upon the year in which VD is getting filed. So earlier the VD is filed, lesser the penalty is imposed by the authorities, which again is a welcoming clause for the taxpayers so that the errors can be rectified earlier. Now we will give an example to understand it better. And the late penalty for payment of tax is similar to which has been amended for the late payment of penalty in case of filing of returns. Now suppose that we are making a VD for the period of May 2018, and the amount of tax which is unpaid is 1 lakh dirhams. So in the old regime, there would be a fixed penalty of 5,000, variable penalty of 5% of the tax, which is 5,000 again, and the late penalty for payment, which is calculated as appearing here. The total penalty for filing a VD of May 2018 for a non-payment or a lesser payment of 1 lakh is 3,10,000 dirhams. Now the same penalty in the present regime is, now because this we are assuming that if this VD is a repetition, there would be a penalty of 2,000. We are assuming that the disclosure is made in the last year and where the highest penalty is levied, and hence a penalty of 30,000 dirhams is being levied. And the payment of tax is assumed to be made within 20 days from the filing of VD, which is giving a comfort or a ease to the taxpayers that if the payment is made within 20 days of submission of VD, then there is no penalty. So the total penalty in the revised law or in the revised decision is reduced to 32,000 vis-a-vis 3,10,000 dirhams, which was levied in the earlier regime. So almost 1/10 of the penalty is being levied for a wrongdoing later. So considering the changes in law for the penalties, it is advisable to carry out or to check if there are any corrections which are required in the tax returns prior to receiving a tax notice. And we need not wait to come to that situation that we will receive a notice on or something on those lines. Moving ahead, penalties which are levied for submission of VD after receiving a FTA audit notification. So the fixed penalties are same in case of before filing and after filing. The variable penalty undergoes a change. The variable penalty in case of the old regime is 50% after starting of audit by the FTA, 30% after starting of audit, but before starting the audit by the authorities, and 15% of unpaid tax if no VD is filed and error is found in audit. So the penalties in terms of the value is quite high in the earlier regime, and the late payment penalty for the tax is similar as we have discussed in the earlier slides. The penalties in the revised tax regime are that it would be 50% of the error amount. So we have again assumed the example of 1 lakh, and the 4% penalty, 4% penalty, which is of the tax which is unpaid to the FTA from the due date until the date of receipt of tax assessment, or the 4% of the amount which is not refunded to the FTA. The late penalties for late payment of the penalty for late payment of tax is similar to the penalty which I have levied earlier. The only difference is here the date would start from the receipt of tax assessment. Now, the similar example has been taken for this particular penalty also, where the fixed penalty in the earlier regime was 5,000 because it is a repetition. Thereafter, the variable penalty is 50,000 because it is received, the VD is filed after receipt and before initiating, and the late payment penalties for payment of tax. So considering that the penalties sum up to an amount of 3,55,000 dirhams, in the new regime, considering that it's a repeated voluntary disclosure, the fixed penalty is 2,000. 50% fixed variable penalty is 50,000. 4% of the tax which is unpaid, that is starting from May 18 till September 21, considering the fact that the audit notice is received in September 21, the amount comes up to 1,64,000, and the late payment penalty is not there because the assumption is that the amount shall be paid immediately within 20 days of receipt of assessment. So in that case, the penalty amounts are 2,16,000 dirhams. So in this case, you will observe that it is beneficial to file the VD after receipt of audit and not prior, because there's quite a substantial amount of difference in the penalties which are being levied. Now moving ahead, there are a lot many other penalties which are levied by the FTA authorities, few of which were discussed by Saket in his earlier part. Now coming to the specifics, which are in the routine of any businesses, are that the first one, that is, there is a failure to keep the required documents, records, and other information. In which case, the penalties in the earlier regime were, for the first time, it was a 10,000. In case of repetition, it was 15,000. 50,000. And the revisions in the penalties are quite substantial. From 50,000, it has been reduced to 20,000. Further, in case of failure to submit the tax return within specified time frame, is in the first for the first time it is 1,000, and in case of repetition within 24 months it is 2,000, and even in the revised regime it is the same. Last but not the least, out of the entire lot, is if a tax invoice or a tax credit note is not correctly issued by the taxpayers, the penalty in the old regime was 5,000. And in the new regime is 2,500 per detected case. This detected case means that if a particular description which needs to appear on the invoice is not appearing, for example, the TRN of the service provider, that could be our own client or the client itself. So such case would be a detected case, and for which a penalty of 2,500 would be levied, vis-a-vis a 5,000 which was levied for every document. So again, this is a big change, or a big reduction which has come in, but it is better to ensure that the invoices are correctly issued at the time of issuance itself, or they are rectified, or the proper steps are taken at the time of filing the return and not at a later point when the FAF is received by the taxpayer. Moving ahead, the amnesty scheme, which is introduced and which is a very welcoming provision for the taxpayers, where there is a benefit of 70% of the penalties are being waived off for the taxpayers, provided there are certain conditions which are to be fulfilled. That penalty should be levied prior to 28 June, and it should be not paid in full before the issuance of this document or the effective date. The effective date being 28 June. The tax which is due to be paid is fully paid by 31st of December 2021, and the 30% of the penalties is due and unpaid as on 28th of June, and which must be paid by 31st of December. So there are conditions to ensure that these to avail the benefit of this amnesty scheme, these conditions should be fulfilled in toto, so as to ensure that we are not losing out on the benefit which have been given. Assuming that a 30% of the amount is paid prior to this cabinet decision, then the penalty benefit or the reduction which is given or proposed by the law will not be available to the taxpayer. And in this regard, and for the other penalties, we have prepared a detailed alert which you can refer in the slide deck or in the link which has been provided in this particular presentation. Moving ahead, there are certain changes which are being made in the executive regulations for day-to-day operations of the businesses, which are taken care by us during the filing of returns, or during the review of refund claims that we are submitting for our clients, and other points. The details are available in the update which we have shared earlier, and these are usually followed by the taxpayers, but it is important and correct to ensure that these are actually followed by the taxpayers during the routine course, so as to avoid the penalties which are being levied by the tax authorities for any wrongdoing. And the penalties, as you have seen earlier, are quite high in case of any default. So that's it from my side on the content. Over to you, Saket.
Thank you, Ankit. So as we have seen, while the even the penalty aspect and the amnesty, as I was mentioning, amnesty is something this has come very early on, in the UAE, and the objective is they want to get as more and more people, if there is if there is more and more people being tax compliant in future, so that for the past whatever you have done can be washed off by paying only a 30% penalty. Only difference is in the UAE region, apart from other jurisdiction, the penalty is very, very high. So obviously voluntary disclosure, etc., or sorry, the amnesty scheme goes a long way. If it comes, we should be, wherever we see an opportunity, we should certainly take it up. Now, if you see, we have seen, since the penalty is very draconian vis-a-vis other, vis-a-vis say country like India and all, the penalty is quite high. So it's very essential that we follow the law and we are on the right side of the law. Now, what does that mean, or how do we know, how do we ensure that that happens? So a few things that we can support the taxpayer in the UAE region is: one, we can do a VAT compliance review, wherein we can check what are the various compliance done vis-a-vis, what are the various transactions, etc. We can do that review. And if you find if there is any voluntary disclosures that can be made, we can support in drafting that voluntary disclosures, putting up the number, data supporting, computing what is the liability, etc. And also we can help in preparing the FAF audit file, which means the audit file which kind of do a mock audit or review it before the tax office looks at it, so that we know what are our various challenges, what are the things that needs to be done, say a voluntary disclosure, or if there are any course correction that can be done, those can be done, or at least we'll get to know that what can be the exposure, etc. So that is one can do. And lastly, whenever the audit happens, we can do an on-ground support. So these are the activities there where SKP Nexdigm can support the taxpayers in the UAE region for during this audit period. Lastly, just want to make one remark. We have seen there is a substantial reduction in the penalties. Okay, what it indicates is, whenever there is a substantial reduction in penalty, it indicates that the government or the tax authorities are now going from a trust-based system, wherein they see that the penalties, if there are high penalties, there can be high advantage also. So therefore, what they want to do is they want to make it a bit more benevolent to the taxpayers, so the taxpayers and the relationship between the tax authorities and taxpayers improve, which we are seeing in other jurisdiction also. Probably that's a first step where we can see tomorrow it will be more, maybe it gets further more rationalized, because anyway, despite the reduction also, it's quite high. That's it from our side. We can now take up question, Ankit. We can just take up questions. I think there are 3 of them.
Sure. So the first question which we have, Jitin, do you want to connect or speak?
No, no, Ankit, please go on.
Okay, fine. So one question which we have received is that a cleaner has been hired for the office, and that particular person is not an employee, and an amount of 4,000 is being paid on a monthly basis. And for making that payment, he gives a letter to the company for the services that he has performed. So in this case, there are some other requirements also, which needs to be looked at, whether any tax is being levied by the cleaner for the particular service that he's been providing. If any tax is being levied by the taxpayer, by the cleaner, then in that case, he needs to obtain a registration and issue a tax invoice for the services that he's providing. Only then you'll be able to claim the tax credit. If that is not the criteria, or if you want to just make a payment to him and you are getting a document from him, which is fine, it will not make a concern. The other question that we have received is where there's a relaxation given for no payment of penalty in case where the return is filed earlier than the due date. The question is whether any revision option would be made available by the FTA authorities. So the answer to that is, there should be some clarification which would be provided by the FTA authorities in that regard, and there could be an option coming up in the near future for revising the tax return which has been filed. The next question that we have received is, does the tax authorities consider the financial reporting for incomes and expenses in the FTA audit? The answer is, apart from the return, they will obviously look at the financial statements so as to check whether any expenses which are being paid by the by the company, whether any reverse charge liability triggers in, or any wrong credit has been availed by the taxpayer, or any income which is booked in financials but is not appearing in the return, whether that needs to be taken care during the course of audit. So that could be looked at in detail at the time of audit. The next question is, there is an option which is given in the amnesty scheme that the penalties would be the penalty of 70% would be reduced in case of fulfilling the conditions mentioned, and it is stated that it would be redetermined. So the question which has come up is whether any linking for redetermination would be available on the FTA portal. So the answer to is that once the date of effectiveness of the circular is passed, that is 28th June, a link on the FTA portal will be made available to the taxpayers so as to take benefit of that amnesty scheme. That after that, the next question is whether any handwritten invoice can be submitted for claiming the credit. Answer is yes. The requirements of the tax law, which have been discussed earlier, should be fulfilled. It is not mandated in the tax law that it should be printed or handwritten, something on those lines. So it can be very well claimed. The details as mentioned should be appearing. Thereafter, is it a violation for a company to buy services from a supplier who is in violation of a tax rule, or is it only the supplier who is penalized in the transaction? So this is a difficult question to answer. Obviously, that it is the liability of the supplier to take care of the law. But in case if there is a wrong done happening, or violation of a tax rule by the supplier, it is better to avoid procurement from such vendors, so as to ensure that there is no loss to the company because of the wrongdoing done by the vendor. Thereafter, the next question is reconciliation format defined by FTA. So we'll be sharing the entire presentation where the reconciliation format is also discussed, and which can be used for preparing the entire detailed reconciliation. And the advice is obviously from our side to prepare that at the time of filing the return and not at a later date, because reconciling something which is 2 years, 3 years old also is a very big task in itself. We have answered all questions till now. Anyone else is having any other questions? I think Jitin, we can.
Ankit, we have a couple of questions that just popped in.
Okay. Okay. Yeah. So, okay. So from the invoice date till when we can avail the credit, please share light if there is an expiry date for the invoice date in taking the input credit. So here, the FTA law itself says that the tax credit should be availed in the same quarter or in the subsequent quarter on fulfilling two conditions: that the correct invoice is received and there is an intent to pay within 180 days from the date of invoice. Only then that case, only on the fulfilling of two conditions, the credit can be claimed. If this condition is satisfied later, then in that case, it should be availed, reversed, and claimed later. However, if it is missed to claim in the two periods, then a voluntary disclosure needs to be filed for claiming the credit in the relevant period for which it is being missed, and that ideally should be opted only when the amount of credit is huge, considering the fact that at times even FTA issues a penalty for filing a VD for availing the credit. Thereafter, can we add 5% VAT on PC voucher if we submit? Example, we get our furniture fixed with one person, that is no invoice. I have not been able to understand the question. Can we add 5% on the voucher if we submit? Example, we get our furniture fixed with one person, that is no invoice. If the listener can clarify the question for ease of reference. So you cannot add 5% on it on your own. It should be the supplier who should be charging the VAT, because it would be his liability to charge or not charge.
And plus what happens is he needs to pay the tax to the authorities also, right? If he is not charged on the invoice, probably he would not have paid the tax. So you cannot take the credit if he, if he is not paid.
Correct. And in the even the FAF, which has to be prepared by the taxpayer, it is clearly mentioned that whether the credit has been recovered in the return. So answer to that also needs to be provided. And also the invoice review would happen even by the FTA authorities. Apart from the routine review, which happens at the time of filing of returns, it would be even looked at by the tax authorities. So it is better to, do things correctly in the UAE region. So the recording of the seminar will be shared in the email. The next question. Practice to account the imports in order to reconcile the auto-populated values appearing in 201, looking into the real-time challenge and timing differences. It's a good question to answer. So there is no straightforward jacket answer which I can provide, but obviously because there is a good time available to the taxpayers, because the return filing is only on a quarterly basis. So for the first month, assuming that the tax period is March, April, and May, where the tax return is due in June, in the June month. So for the May month also, you would receive the relevant documents probably by 28th of June. If not, there's an option in the return to make an adjustment of the tax on import of goods. But we generally suggest clients not to opt for that option, because it could be looked at differently by the tax authorities, and which requires detailed explanation at the time of audit or refund claim which happens. Because at the time of refund claim review by the authorities, there are numerous questions which are being asked by the authorities, and which cannot be thought of by the taxpayers. So that is an answer, probably a suggestion to the questioner.
Thanks, Ankit. Saket, Ankit, should we conclude?
Yeah, I think so. We've answered all the questions. Maybe we can.
Correct.
Okay. So thank you for making this a very interactive session. I would like to thanks once again to our speakers, Saket and Ankit, to share their valuable insights on the subject. I'm sure all of you found it relevant. If you still have any questions in line with the discussion today, we welcome you to reach out to us at thinknext@nextdime.com, and our team will be happy to respond offline. Across the globe, we think next and invite you to do the same. We will welcome your feedback on today's presentation. Be vigilant, stay safe. Thank you and have a great day ahead.
Thank you. Thank you, everyone.